Well, welcome everyone to our landlord information evening, and thank you all for joining us tonight. We have our first of a series of events that we'll be running and special guests that we will be having on our landlord information evenings. Our first is Steve from SJB Quantity Surveyors. We'll be talking all things tax depreciation. We thank him so much for joining us tonight, and I'm sure that this will be an opportunity for a lot of you to ask questions about tax depreciation. I know something that is one thing that comes up definitely from a sales side of things, and also from a lot of our landlords. So it's a great opportunity to be able to ask Steve a lot of questions on that. Also tonight at the end of this session, we'll be also just touching on the federal budget, which was announced last night. So Michael and I'll sort of give you a bit of a run through of that and what that sort of means for us and our clients as well. So at this point, Michael, welcome. I know that last night was one of your most favourite nights of the year. Runs just in front of June 30 at the end of financial year. So I'm sure we'll cover, or you'll be covering off on a lot of that later on today.
Yeah, it does. No, look, it is a big night, and it got delayed about 6 months this year as well. So it is a fairly big night for us, but it's good. I think it was a positive message last night. We'll talk a little bit about that, I think, in a bit more detail at the end of today's session. But quite obviously a big spending budget, which I think we all expected to try and get us get some sort of recovery happening here in Australia, and particularly here in Victoria as well. So it was quite a good one. There's a fair bit there to cover off on, and also some kind of indirect impacts around the property market as well, which would be good. But as Anthony said, we've got a special guest in tonight. This will be the first in a series of events that we'll be doing, where we're bringing, I suppose, some outside knowledge to our landlords. Obviously, we've seen the benefits of doing these sessions over the course of the last 6 months or so with our landlords, but being able to hear from someone other than Anthony and I on some experts in the industry that actually can provide you with some more additional information is always nice. So to that end, Steve, welcome, and thank you for joining us tonight.
Pleasure to be here. Thanks for inviting me.
Perfect. So Steve, I suppose the reason why we've asked you on is to talk a little bit about depreciation schedules. Similar to the budget, probably not the most exciting of things, but certainly something that's really important when it comes to property investment. So whether it be rentals or sales, it's obviously a really important area, and we do get a lot of questions about it. So what is a depreciation schedule?
Well, okay, so the ATO allows you to claim the loss in value or the wear and tear of an investment property as a tax deduction, and this is done in the form of a tax depreciation schedule against your taxable income when you lodge your tax return. So the tax depreciation schedule is simply the document that shows you how much depreciation you can claim on your property every year from when it was first available for rent. So this pretty much just helps you lower how much tax you pay at the end of the year. So say, for example, a depreciation schedule tells you that you get to claim $10,000 in depreciation in a particular year. So what you do is you take that off your total taxable income. So say your taxable income's $100,000. If we take 10,000 off, you're paying tax on 90,000 instead of 100,000 in essence, right? So obviously it reduces the amount of tax you pay.
Yeah. So it would be a particular benefit then where you've got an investment property that might be, slightly positively geared, so you actually are in a tax payable position on that, or you might not have any borrowing. So if you've been fortunate enough to be able to buy the property outright, obviously you don't have that tax deductibility of a loan or something against it. You can use that obviously then to offset some of the income that you're generating. Is that correct?
Yeah, absolutely. So depreciation is actually probably the second biggest claim you'll ever have against your investment property, aside from the loan portion of it. Okay.
Yep. No, perfect. And then in terms of how long it lasts for. So once you have a depreciation schedule prepared, is it something that needs to be done on a 5-yearly basis, or how often would an investment property owner need to prepare a depreciation schedule?
Well, the best part about a depreciation schedule is you only need to do it once for as long as you own the property. So a depreciation schedule lasts for 40 years from whenever you start the depreciation schedule. So you don't have to worry too much about getting another one ever. You just hand it over to your accountant. If you use the same accountant all the time, then fantastic. Then you never even have to think about it, and they'll just take care of it for you each and every year.
Great. Yeah, perfect. So, so around that as well, I suppose, you know, obviously located in the suburban or in the suburbs of Melbourne, we obviously manage quite a few apartments, and you know, there's obviously some depreciation benefits there. But what are the sorts of things that a landlord can look at depreciating with their depreciation schedule? What are the sort of things that they can look at depreciating in, say, a residential apartment? And what would they be looking at? I know it's probably a bit of a loaded question, but what would they be looking at in terms of the deductibility of one of those in a suburban apartment, say, you know, a standard 2-bedroom with a reasonable fit out?
Sure. Okay. So without turning this into a lesson on depreciation, I've got to break down the depreciation schedule for you first so you can understand. So it gets broken down into 2 parts. It's what we call plant and equipment. So that's the things like carpet, curtains, blinds, air conditioners, ovens, cooktops, range hoods, those sort of things, right? The things we can easily take out of a property. And then the second part of it is the building component or the capital allowance. So that's the structure, your floor, your walls, your roof, all of that sort of stuff. Okay. The best part about units is that you get to claim your portion of what we call the common property. So say, for example, there's, let's just say 20 units in a building, you get to claim 1/20th of the common property items. So what we mean by that is obviously the structure, the building component that makes up those areas, like your foyers and your hallways and all that sort of stuff, right? And then there's the plant and equipment items that are part of the common property. So you get your portion of lifts, pumps in the ground underneath the lifts and stuff like that, right? You know, fire indicator panels, security systems, intercom systems, all of those sort of things. You get your part on each and every one of those things. Okay, so at the end of the day, your example was 2-bed, 2-bath in a city unit. You'd be looking at, I know that's sort of a how long's a piece of string kind of question, but you're looking at, in your first full year, you'd be looking at somewhere between, say, 12 and 17,000 in depreciation, obviously depending on the size of the building that it's in. Okay, which is a substantial amount of money. Yeah.
No, and then I suppose when you look at that in comparison to the income that you'd make on a property like that, so you're probably looking at, you know, anywhere between $25,000 and $30,000 a year in income that you generate, rental income that you generate on that property, taking between $12,000 and $17,000 off that taxable income obviously has a pretty significant benefit. Obviously, you know, it almost halves the taxable amount instantly, doesn't it?
Absolutely, yeah. It's something that unfortunately I think the percentage is still around 55 to 60% of investors still don't know about or have a tax depreciation schedule done for their investment properties. So there's a lot of people out there leaving a lot of money on the table and giving it to the ATO. So it's unfortunate.
Yeah, and look, I think that's probably a good opportunity just to mention, you know, Anthony, I don't know if Anthony mentioned at the start, but obviously Q&A is open there, and if there's any questions that kind of come through, or if you've got any questions as we're going through, certainly send them through the Q&A. But at that point as well, you know, we know through conversations with quite a lot of landlords, it comes as a bit of a surprise around what a depreciation schedule is, and then the benefits that they're able to receive from it. And it also, I suppose, the ability to then also backdate it as well on a couple of previous years' returns. So, for example, if you've lodged a couple of returns for the last 2 financial years, you can actually get your depreciation schedule and backdate it. So, you know, if you do have a property at the moment, getting tax returns prepared on it, haven't had a depreciation schedule prepared, and we haven't reached out to you already to organise that, certainly just reach out to your property manager or myself directly, and we can certainly arrange for that to be organised and prepared for you. Just a couple of other questions, Steve, as well. These are, I suppose, where they start getting a bit more technical, because obviously I've got a bit of an interest given my accounting background. But I know that there was a change in 2017 of how the depreciation schedules were used. So it was around whether you're buying a brand new property or you're buying a property off the plan, and being able to claim deductions on certain items within the property.
Yep. Yeah, so the law changed around, as you mentioned, second-hand property. So if you purchase a second-hand property after the 9th of May 2017, you're no longer allowed to claim depreciation on the plant and equipment within that property. Okay, so unfortunately, as I mentioned before, all those items like carpet, curtains, blinds, air conditioners, ovens, cooktops, range hoods, all those sort of things, you unfortunately won't be able to claim those anymore. It also affects principal places of residence that get converted or turned into an investment property. So if you have a principal place of residence and you start renting it out after the 1st of July 2017, it's also deemed to be classed as a second-hand property. And once again, you're not allowed to claim depreciation on the plant and equipment within the property. The only way you can claim plant and equipment on a second-hand property is if you purchase it directly yourself for the purpose of rental.
Yes, right. Yeah, okay. So that's one of those things, and Anthony mentioned that I enjoy budget night every year, and that was one of those things that I think was mentioned a few years ago back in 2017. Hence the start date there being in May, which would have been the night of the budget. I know it was one of those things that got announced and didn't really make too much noise, but I remember when I was reading through it, I saw that I was actually quite shocked, because on a lot of investment properties that forms a pretty big portion of the depreciation, or the allowable depreciation for them. And what I think it was at a time where there was talk about removing negative gearing and the impacts of that, because it seemed that it was unfair towards property investors. But it also, I think, helped direct a bit more money and new investment money towards off the plan style properties and brand new properties, which again helps drive building and all of those sorts of things. So certainly consideration there when you are buying a property. Consider the depreciation, because a lot of people probably don't, but it's something that becomes really important, because when you're looking at buying brand new versus buying existing, what's that impact of depreciation over the lifetime of the asset as well.
Yeah, unfortunately, that change in law's taken about 50% of depreciation off the table for second-hand properties. So just to clarify, that does not affect, that law change does not affect new properties or commercial and industrial properties. Okay, so it's only second-hand residential properties that it affects.
Yep, perfect. And also, just I suppose to that point too, around commercial, is there we've obviously been speaking about residential quite a bit throughout this, but does can you have a depreciation schedule and are the benefits similar for a commercial property as well?
Absolutely, yeah, absolutely. The benefits depends on what the commercial property is. Obviously, a small industrial warehouse doesn't have a lot of plant and equipment items in it, and probably doesn't cost as much to build as a high-rise unit would. So there'll be a little bit less in that. But then you go to the flip side of that, and you go to a large commercial office space where there's could be a $3 or $4 million build, and there's a substantial amount of depreciation in something like that.
Yep. Perfect.
Steve, just on that, so just a quick question with the commercial, the fit out, I'd assume would be up to onto the tenant. So the tenant was to fit out a commercial premise, you couldn't then go in there and, for instance, if it's a cafe, you couldn't, as an owner, depreciate the coffee machine and the kitchen benches and the oven that they've put in.
No, that's right. It depends who owns that. So if you were a tenant, and you signed an agreement where the owner of the building paid for the fit out, then the owner of the building can claim the fit out because they paid for it, right? But obviously, most of the time, the tenant pays for their own fit out. So they typically purchase a vacant or an empty shell, or a cold shell is what we typically call it. Right? So yeah, it all depends on who owns what. As to
probably another reason. Sorry, Alan.
That's all.
No, I was just going to say it's probably one reason why you're starting to see a lot more commercial places around the CBD offering full fit outs included in the rent, because obviously a benefit to the owners and to depreciate that over a period of time and get better tax benefits on that as well. Yeah.
Yeah, absolutely. Yeah, one of the reasons.
Right. We've actually just had a question come through on the Q&A. So just a quote. They're asking how much for a quote to do a depreciation schedule for a one-bedroom apartment. Steve, your pricing on preparing a depreciation schedule?
Yeah, for anyone that comes through you guys, the fee's $440 including GST.
Yep, great, perfect. So that covers off on all residential depreciation schedules as well. So irrespective of the age of the building, it's $440. That does come at a bit of a discount as well. I know we've used other providers in the past where they have come through significantly more expensive than that, depending on whether they need to do a physical inspection or not. But Steve, as he was kind enough to do the presentation for us tonight, he's also given us that offer, which is available to all of our clients. So Anthony will type back to that person who's just come through. Unfortunately, it's come through as anonymous, but we'll respond to that person there and just provide contact details for either Anthony or myself, and we can coordinate that. And that kind of leads to my last question as well, Steve, just around providing quotes and giving an idea to people on whether it's actually beneficial for them to prepare a depreciation schedule. Is that a service that you'd be willing to provide if someone was to say, look, I've got an apartment that's, say a studio apartment in Carlton. I bought it 10 years ago, want to know whether it's worthwhile me getting a depreciation schedule prepared. Is that something that you can provide, say, over the phone or remotely for us?
Absolutely. Either way, give me a call, send me an email. I'm happy to have a chat, tell you what you can and can't do, give you an estimate of what you might expect to get back in depreciation, and then you can make a decision from there as to whether you want to move forward or not. The process is simple. We try to make everything as simple as we humanly possible. So, yeah. No,
that's great. That's good. Beautiful. Perfect. Anthony, did you have any other questions at all for Steve?
Just two. I was just responding to that. I think he may have already asked the question, but going out to inspect the property, is that a must? I mean, especially now during this whole COVID situation, especially down here in Melbourne, is it do you have to go out and inspect? How does that sort of work?
Every property is different, so it depends on how much information we can find online and whether or not they claim plant and equipment. So obviously, if it's a brand new property, we would definitely inspect it. If it's a second-hand property, then we will make a decision based on whether or not they can claim the plant and equipment, or whether it's been renovated, to what extent it was renovated, whether it was renovated by the current owner or by previous owners. So sometimes it's more beneficial for us to go and look at an older property so we can find a lot of those little renovations that the new owners aren't aware of. And that just really means that they can get some extra depreciation back because they can claim renovations done by previous owners. So yeah, it just depends, right? It's a bit of an open-ended question and then a bit of an open-ended answer, unfortunately. But in this current climate, it really depends. But we try and inspect as many properties as we possibly can.
It's probably in the best interest to inspect as well. I mean, like you said, you're probably getting a better understanding of what the property has and what it has to offer as well. So you're probably going to be able to get that every last little cent out of it rather than just sort of doing it remotely. But and the other question that I had was just with regards to this from a sales, I guess, perspective. One thing that we get asked a lot is, does the owner have a depreciation schedule? And can they send that to them? Are they transferable? And can it go from one owner to the next owner and a new owner? And do those I guess, around 2017 and that those things there, does that affect it at all?
Yeah, well, that would be the first thing we look at. So the first part of your question is, are they transferable? And the answer is yes, they are. And that's purely because a depreciation schedule is actually for the property itself and not for the owner of the property, right? So it relates to the property. What we tell all of our clients, if they're offered a depreciation schedule by a previous owner, is to accept it, use it as a guide, and get another depreciation done. Obviously, it depends with the dates and whether it's new, old, or whatever. Well, actually, it's going to be old anyway. It's going to be secondhand. So it all depends on the dates, whether they can, what they can claim, what they can't claim. And at the end of the day, if they can claim plant and equipment still, we would most probably value it higher than what that item has depreciated by in the existing schedule anyway. So again, it means they're most probably going to get more depreciation than what that existing schedule would show. Okay, so that's part of the process. Yeah.
That's great. And we've had just another a lot of questions about the cost of these and preparing them, I suppose, if there's renovations and things. But there has been another question that's come through around if we renovate the property in future, do we need another schedule, and what would be the cost of preparing that schedule for a new post renovation?
A great question. So if we've already done a schedule for that property, right, what we ask all of our clients to do is, if they're going to renovate a property, is to keep a list of the items that they've done, the date they were completed, and their cost. If they can provide us with the renovation items, like a little schedule of items and costs, we can update their schedule at no cost. Right? The only time there's going to be a cost involved is if we have to go and inspect the property to work out what was done. And in that case, you will only be charged an inspection fee. There won't be a full fee. It'll just be an inspection fee.
That's great. That's fantastic. That's really useful. And I know we've been during this kind of COVID period, there's been quite a few apartment renovations happening, obviously with vacancy rates being a little bit higher and properties taking a little bit longer than what they usually would to lease. People have been using it as a bit of an opportunity to renovate some apartments. So really important that you hold on to those receipts, and where we're all obviously organising the works for you, we'll have full details from the contractor for the works that were completed, and we can certainly ask for a list of all the items that were installed, if it be new kitchen items that were installed or bench tops and things like that too. So that's really fantastic, Steve. That's that's good. I actually did not know the answer to that, so that's I didn't realise you'd update them for free. So that's a really great service. Perfect.
Just one thing. Sorry, Michael, if I could just say one thing. If you're living, and this is about renovation, so if you're living in a property and you're thinking about renting it out and you're also thinking about renovating it, please move out before you start your renovation. Then you can claim everything in the renovation. If you live in the property while you're renovating it, you won't be able to claim any plant and equipment items, okay? They'll be classed as second-hand and you won't be able to claim them. So don't go and do a $25,000 kitchen renovation with, $6,000 or $7,000 worth of appliances and then you can't claim them, okay? So move out first and then renovate before you rent.
Right. Yeah, really good advice. Very, very good advice. Yeah. We've got a member of this call that's currently undertaking a pretty major renovation. So if he wasn't renovating to live in, that would be very good advice to him too. So
well, one of our owners may be able to do the depreciation schedule on my property and just claim it on their own if they want to. I haven't moved in there yet.
That's true. Yeah, that's true. No, that's really good. Really, really great. Anthony, did you have any more questions at all, or?
No, I didn't. No, I those were only sort of two questions that I had for Steve, but that's all from me.
Great. No, that's fantastic. So, Steve, thank you again. Thank you again for that. You're okay to stay on for another 10 or 15 minutes while we run through the next bit, and just in case there's any more questions that come through.
Absolutely. Yep.
Perfect. No problem.
Feel free to
All
join
right.
in any time too, Steve. If you've got any input into this. I must admit I missed the budget last night, so I've read up on a little bit of it today. But if you've got anything you want to chime in and put Michael under the pump a little bit and ask him a few questions about it, now you can return serve.
Sure.
Jeez, it's a worry. I did.
So,
Yeah. No, you're right.
There you go.
No, I was about to say I did have a glass of wine in hand while I was watching it last night. So not too many questions, please.
No, the first one I was going to throw to you was going to be that winners and losers. I know it's one thing that is sort of written about, and I sort of got the notification come through from the Age, and everyone sort of jumps to that, who the winners, who the losers are. I guess as real estate, were we winners, were we losers? How do we sort of fare on that side of it?
So real estate was left out a little bit, to be honest. There wasn't really too much in there. We spoke at the last landlord session a little bit around the benefits that were given to around property through the coronavirus period, and the fact that there was grants being given out by the Department of Health and Human Services and those sorts of things, but none of them were really targeted at landlords. It was all very much tenant assistance. So landlords have had to obviously carry the majority of the brunt there. And unfortunately, last night was fairly similar. I think the federal government has a view that property investment, whilst they're happy to tax you on it, should you be earning an income at the end of the year, they see it very much as a state government issue. It's not necessarily a federal government issue, because they see the states as the governing bodies for a lot of the tenancies, or all of the tenancies acts essentially around the country, because they're all individually managed by the states. So to that end, there's not really been a huge amount for property investors. There's been no, look, I suppose on the positive side, there's no negative items that are in there. They're certainly not looking at, taking away things like negative gearing or changing depreciation schedules or any of those sorts of things, which is a good thing, particularly in a year where I think you're likely to see a lot more people having more negatively geared assets than positively geared because of vacancy rates and lowering rents. So to that end, I suppose certainly not winners, but not really losers either. So no real direct impact, unfortunately, to property investors in last night's budget that I could see. Just to that, Anthony, I'll I suppose elaborating on that a little bit. What I found quite interesting throughout all of that was that there was, I suppose, buried within the detail there was quite a lot of I suppose around the budget itself. Actually, they do quite a lot of work, obviously, to try and calculate what the tax revenue is going to be over the course of the next 4 years, which is what they consider the forward estimates. Buried within that detail, obviously, Treasury need to do estimates around population growth and the number of taxpayers that are in the country, both through the fixed taxes, so what people are spending, so through GST collection, but also through income tax, so the number of workers that are in the country that then pay income tax, which then contributes towards the budget top line. So obviously that population growth number was something that I was really interested in seeing what they thought. And what was made quite clear was that, the government is factoring in a vaccine to be found hopefully by the end of this year, and to be widely available by around the middle of next year, which would mean that they could begin to loosen borders with the rest of the world. I know, having spoken to a lot of our landlords over the course of the last couple of months, everyone was just hoping that 2021 would, we'd flick a switch and everything would return to normal, but it's starting to look increasingly like that's not going to be the case. I think we're going to see bans on any sort of inbound immigration into Australia until probably at least the middle of next year, but more likely probably towards the end of next year. So, whilst the vaccine might be available widely by the middle of next year, to see other countries have it by, to see real vaccination rates across that, but it's probably going to take until the end of next year. So around population growth, some of the interesting numbers, and I sketched some of them down earlier as well because I found them quite interesting. So they're saying that 2018-19 financial year, we saw as a state, or as a city, Melbourne saw around 240,000 people migrate to Victoria and particularly to Melbourne. This financial year, they're expecting that to be down by almost half. And then they're expecting it to come back above 200,000 people in around 2023, 24. So what that essentially says is that we're not going to see migration levels return to what they were basically last year until 23, 24, which is 3.5, 4 years from now. So it's quite daunting, I think, reading that. You know, having spoken to a lot of landlords over the last few months and saying, look, you know, whilst obviously rents have come back pretty significantly in Melbourne and, you know, Melbourne CBD, South Bank, all those inner suburban areas have really taken a hit because obviously, you know, the multitude of effects you've had, you know, all the offices essentially closed in the city, which will obviously come back next year. Migration's down, so all the students that were staying in, you know, CBD, Carlton are no longer there because they've all headed home. And then you've obviously got you know, overseas travellers, so visitors that are staying in hotels and Airbnbs and things like that. They're all gone as well. We're essentially saying that's not going to really return for at least 12 months, but realistically not return to the levels that it was last year until kind of 3 years from now. So what I think we're going to see is probably a prolonged period of lower rents in the CBD. I feel like we're starting to get to a bit of an equilibrium on price. I know there's a lot of vacant properties out there at the moment, but we're starting to hit that kind of equilibrium. So you've seen rents come off about 20-25% in the CBD. I think they'll probably level off at around that 25% mark. But I think you're probably going to see a relatively gradual increase from there. I don't think it's going to be this kind of sharp correction that I think a lot of people were hoping for. And look, ourselves included, we would have loved to have seen a sharp correction back to the way things were, but I think it will be certainly gradual, and it is really dependent on the government allowing people to travel back to Australia, and then, you know, seeing universities, you know, fire back up again, and international students coming back, allowing, you know, migrants to come in and holiday here and those sorts of things. So that was really interesting. It's not buried, it's not, you know, it's not frontline budget, and it's not, you know, part of the cash handouts and all that sort of stuff, but it tells a really interesting story around what's happening and what's coming. So there's that. Look, around the cuts itself, I think they've done the right thing. So they've brought forward some tax cuts, some personal income tax cuts. So they were due to come in a couple of years' time in 2022. They've been brought forward, so it kind of puts, you know, an extra couple of $1,000s in everybody's pocket, and people will then have the ability to spend that. There's a lot of spending around business, so allowing businesses to claim deductions against certain items that they're buying. So it's kind of unlimited. It was capped at 150K. Now it's just unlimited. So buy machinery and all the other things that businesses can buy to encourage investment. And also a lot of wage subsidies. So again, getting people back in work. So it's really just about supporting the local economy at the moment, get things kind of, you know, motoring away again locally while we wait for this vaccine to happen. And then hopefully once things open up, we can start gradually letting people back in and going from there. But that's, like I said, the most interesting piece for me last night that I took out of it was around that population growth figure. Because like I said, it's quite sobering when you see that and you think that, you know, particularly in Melbourne, we were growing at the fastest rate of any capital city in Australia. And we were due to eclipse Sydney, I think, in 2 or 3 years' time in terms of number of people, you know, living in the city. But that's, you know, obviously came to a screaming halt back in March, April. But yeah, unfortunately, it's kind of looking like it might be a fairly gradual recovery. Without sounding too doom and gloom, obviously, because it is a bit negative. But look, the thing is there that you know, it will return, and thankfully the last piece there was really around infrastructure spend, and they are directing a lot of that infrastructure spend in Melbourne. So what they're going to try and do over the course of the next couple of years, while we don't have that population growth, we've actually probably got an opportunity to kind of catch up as a city and go, okay, where does money need to be spent on better transport, better roads, better ways of getting around Melbourne. So when that population growth returns, which they say it will, which is a good thing. They're not saying that it's not going to return. They're saying that it certainly will return. That we're actually better for it, and we're more equipped for a larger population to be able to move around the city a lot more freely, which is something that I know, Anthony, we really started to feel towards the tail end of last year. It was really starting to get quite congested, and it was moving around the city was getting quite tough. So I suppose having this opportunity to do that's probably not a bad thing.
Definitely. That's one thing, actually, I did catch a glimpse of it last night. And actually, the part that I did watch was when the Treasurer was talking about that if you don't spend it, you lose it on infrastructure. So, they're going to hand out these money for projects, but if you're not going to use it, you're not going to get the money. They're going to take it back and give it to states that are going to invest in infrastructure, which is good. So hopefully, they do spend it in the right areas, and they do, take this opportunity, as you said, to really spend it in infrastructure. I mean, we always cry for better roads and better transport in Melbourne. So hopefully they can spend it on that and improve it, because it was desperately needed. It's amazing. It would go from, taking sometimes 45 minutes to drive from one end of the city to the other, whereas now it takes 5 minutes because there's no one in the city, but it takes you 3 hours to try and find a car park, because during stage 4 they've given out free parking in Melbourne. So you get rid of one problem, but you cause another. But no, I sort of there's from what I got from it and what I sort of saw, there was some good initiatives in there. I think the one thing that, if you're going to be critical on the whole, getting people back to work, and that, the job maker, I love the whole job maker, job keeper, job seeker, phrases, but I'd probably say they should have had that unlimited, not put an age cap on that at 35. That should have really been, to anyone. Why? I know there's a lot of younger people that have been out of work and have lost their jobs, from BC, whether they're uni students and looking to get, cafe work and those part-time jobs. It's a good opportunity to get them back to work. But, there's a lot of people, and we've got landlords and tenants that are older than 35 that have lost their jobs and stuff like that. Why have they sort of been forgotten in all of this? So that was just one thing that I sort of, if you're going to be critical on one thing, that was probably what I was going to be. But it's good to know that real estate wasn't affected by this. As you sort of said, Michael, it was probably an easy grab if they wanted to tax, to get rid of depreciations, or to get rid of some sort of tax benefit to investors, because it's just an easy grab in a situation like this. They could have very well just taken that away. So it was good to know that we got through it pretty much unscathed. But again, pretty worrying and scary about the migration numbers. And we're even just finding it now. I mean, Jonathan from our office listed a place today on St Kilda Road where the an older lady, she's packing up, moving to Queensland over it. Wants to get out of Melbourne. She's had enough. She's got kids up there in Queensland, and she's like, I'm just need to get out of here. I've just had enough of, being, her words were, being caged up and locked up in jail. She always wanted to get out and enjoy life. So hopefully we're able to get through this, because we don't want to see people leave Melbourne. It is the greatest city in the world for a reason. So we want to make sure that people keep coming here and can actually stay here as well.
Yeah, and look, and that was there has been a little bit of talk of that, of people that have lived in Melbourne for extended periods of time moving into state because of the restrictions and things, and I suppose that's I think it's probably more of a short-term impact than longer term. Like we have seen that, obviously, people relocating out of the CBD into the suburbs, and and then going further, people relocating from the suburbs and going into state because of the, I suppose, more relaxed restrictions that are happening, and not having the outbreak that we had here a couple of months ago. But it's I feel like we're at the tail end of that. Today, what was it, 6 new cases or something here in Victoria? We're almost less than New South Wales today, which is a bit of a win. So got to be happy about that. But look, it has been tough, but I feel like we're on the other side of that. We went through the stage 4, which was challenging, obviously not being able to get out there, and challenging from a business sense as well, because obviously we weren't able to open any properties up. But longer term, hopefully it means that we've taken control of it and been able to I suppose get on top of it, which is a good thing. And like I said, I think there are some people that are kind of fed up with it and are happy to move interstate, but I think hopefully that will be a short-lived thing and they realise the benefits of living in Melbourne and they'll be back soon. So just on that, Anthony, as well, you mentioned that that Jonathan listed that property there on St Kilda Road. How is, obviously and I might cover off on rentals in a minute as well, but how are you finding the sales market now that we can do inspections again? It's been just over a week and a half now that we've been able to do some sales opens. How have you found it?
It's been interesting. It's we're, like I said, we're back doing opens, which is great. Felt like Christmas when it was announced they were able to go back and start doing inspections again. It was one of the most exciting days of my life. Literally was here, upstairs I'm staying at the moment, jumping up and down and said to my wife, turn around and said, "Are you right?" I'm like, "No, I can go back to work. Like I'm excited. Leave me alone." But no, we've seen some good numbers. So in terms of last week, Saturday, we did, between Jonathan and I, over 20 inspections, private inspections on properties. Personally, this week we've already done sort of 15 to 20 during the week, and it was sort of 25, 30 last week. So sort of big numbers of people that are out and about looking, and it is resulting into offers. What we're seeing though is probably, in most cases, offers that are coming in probably 10% below asking price, and that's made up of a number of things, but most of it is that people are trying to take advantage of the situation a little bit, and sort of wanting to see if there's a bargain to be had out there. But at the same time, you don't want to sort of discount it and think it's just that they're offering 10% below asking, and they are trying to get it at a discount, because if they do end up buying through another agent, or they buy another property, then that becomes the standard of the market, and then very quickly will that then become the price point, and then your comparable sales and the recent sales around your particular apartment. So it's about sort of looking at it on a case by case basis and sort of seeing where the market sits, what other interests you've got, where's everything else sort of happening. Because our goal has always been that if there's going to be if the next sale in Melbourne is to be, we want our property to be that next property that's sold. So coming out of what we sort of saw over the last sort of 8 weeks, where we were able to put a few deals together, which was great, and they relatively held up pretty well in terms of price. But it'll be an interesting sort of 3 to 4 weeks to see when these transactions start going through and these properties start getting sold, where do they actually end up falling, and what interest sort of stays for an extended period of time.
Yeah. It's interesting. And just a quick update on rentals as well. Obviously, there's vacancy rates of, like I said, they've hovered around that kind of 5 to 10% most of the year, and they have crept up around the 10% mark now, because there was quite a lot of properties that kind of came to market, and there wasn't a huge amount of transactions in terms of properties being leased through that stage 4 lockdown. I think you'll see those numbers start to dip quite quickly again, because we've certainly seen a huge amount of activity over the course of the last week and a half. I know out doing opens on Saturday or doing inspections on Saturday, the team had 40 groups through. Huge numbers just in one day. And we've had something like close to 400 inspections, I think, in a week and a half. So it's a huge number that's kind of come through. And then applications off the back of that. So there was a little bit of pent-up demand there in the rental market as well, which we'll see some movement in stock. But I suppose just the message to all of our landlords is, make sure that we're priced effectively, and the team are working really hard to just make sure that we're priced effectively in accordance with others that are in the building. That just seems to be the most effective strategy at the moment. There is a big drive within the office to make sure that we've got professional photos, like quality photography. We've got making sure the ads are looking as clean as they possibly can, because obviously with so many on the market, you need to try and stand out amongst the crowd. But tenants are ultimately motivated by price as well. So you need to just make sure that you're adjusting the price and making sure you're meeting the market all the time. So I know the team are working around the clock at the moment, trying to just make sure that where you've got something and there's comparables in the building or in surrounding buildings, that you are priced effectively to make sure that we secure a tenant quickly for you, and help things move along, because there's nothing worse than having a property sitting there vacant. So we're pushing really hard for that at the moment. So hopefully yeah, over the course of the next month or so, we should get that vacancy rate down towards 5% again, which will be quite good. Yeah. Perfect. All right. Well, I think we might wrap it up there. Anthony, anything more that you wanted to cover off on at all?
No, that was it. That was all. But thank you so much to Steve. I'm not sure if you've got any sort of questions you want to sort of throw our way after sort of hearing all that. But no, thanks so much for joining us, and yeah, thanks again, Mike.
Appreciate it. Yeah, thank you, Steve. I really appreciate your contribution tonight. It was fantastic having you involved. And again, just if anybody's got anything that they any depreciation schedules, or they've got any questions about depreciation schedules, certainly reach out to Anthony and I. I'll just pop our details actually up on the screen. Certainly reach out to Anthony and I, and we can we'll certainly refer you on to Steve as well. And yeah, more than happy to answer any questions that you got around that, or help you organise that. Obviously, the team are pretty well versed at organising inspections to be done and those sorts of things as well. So obviously, coming through us, we'll organise with the tenant to make sure that there's a time for a member of Steve's team to be able to go through and do that. But yeah, thanks again, Steve. Anthony, thank you, and thank you everybody for joining us tonight.
See you later.
Thank you. Bye bye.